Welcome everyone. Welcome to Rethinking Balance Sheets. And joining me today, as ever, is Ravi from Sage 3 Capital. Ravi, welcome to the show. Rethinking Balance Sheets, we've into I think week number 21 now, Ravi, and we've been talking about a whole bunch of very interesting topics over the last couple of weeks. I think we had Nora from Maybank, and then we had Jim Ling from Hong Leong Investments last week. Who do we have up this week, and Ravi, and what are we going to talk about?
Okay, I think we're a little bit diving deeper into corporate finance this week, just like we did last week. We did SPACs last week, and today is probably one of the a topic that's it's in people's mind. We've got Wong Muh Rong of Astramina, managing director and founder of the business. Also a former colleague of mine in Danahata, a very smart lady. She's built up one of the very successful boutique firms in Malaysia called Astramina Advisory, and she was not only with me in Danahata, she was also some time with me in PwC Consulting, and then went on to join another boutique firm. And she's certainly one of the persons who, she's done a lot of corporate finance work, but I've asked her to come onto this show mainly to help us talk about this issue of privatization. I think it's still topical. We do see some of it happening. We've seen quite some big ones like FGV and all considering privatization. So it's not off the radar, it's back on the radar. And so some public companies are looking on this. And we should have a pretty good discussion as always. If people can start asking as many questions as they can.
Absolutely.
This is a corporate finance show that brings on practitioners onto the show. What you can
Absolutely.
read a book or an article, you can't. Ask us many questions. We've got a whole host of questions, but you know the rule. If there's an outside question, we give preference to that first.
All right. So let's get Wong Muh Rong on. Muh Rong, welcome to the show. Really glad to have you with us. And Ravi's been telling us so much about the different aspects that you can enlighten us, especially in regards to privatization. And I think maybe we can kick off by just talking a little bit about privatization in general and your insights on privatization, right?
Yeah, good morning, Roshan and Ravi. Is Muh Rong here. Good morning, everybody. I think privatization, for me, privatization is a very, it's a general terms. It's just like M&A. I think privatization needs to go hands in hand with the M&A activity. I think corporate finance terminology, people are generally familiar with what is M&A, merger and acquisition. But when you do a merger and you do an acquisition, there tends to be involving privatization. There will be one guy on the other side that is already being taken out and is actually being privatized. That's where we do M&A. Yeah, I think in that general forms, we hardly see any privatization just on its own. Unless owners are very old, they just sick or tired with the exchange, and they just want to get out from the radar screen and then just get being a private entity. You have instances like that, but they are very rare. Yeah, but normally when people do privatization, it's always have a objective or a goal. Eventually, we'll do a releasing, or we'll do an M&A with somebody. Or actually, you want to sell part of your business to a private equity firms. It's always come with that sort of angle. It doesn't actually just stay and say, I just want to do privatization because I feel like paying a minority shareholders. Very, very seldom you have that sort of instances. Yeah. Okay.
Thanks, Muh Rong. Just coming back to this idea of, but maybe before we get on to the more meaty things about privatization. Last week we had Miss Lee Jim Ling of Hong Leong Investment Bank, and she just spent a lot of time talking to her about the role of an investment bank. It's probably the first time since she's been on the show, but we're a little bit different. And it wouldn't be so right for us to talk about the boutique firm, but it'd probably be best that someone like you just today explain a little bit. We've had a couple of boutique firms at Wong Muh Rong as well on board, but just tell us that why is it the difference between a boutique firm and an investment bank when looking at the balance sheet, and why would someone go to a boutique firm and they can go straight to an investment bank?
Okay, that's a good question, Ravi. You're doing a bit of publicity for Astramina, but I think certainly, as I said, there must be a value proposition. Boutique advisory firms can survive in this very competitive capital market and investment banking market. I think one of the key, most important elements, I think, is independency. Is independency and ability to basically keep deals in the most secret manner. And if you speak to an investment bank, for instance, on any deals, all right, the investment bank will first think, how can I fund this deal? I will have to look up my banking side. I will have to sell the deal with my equity side. I will have to see how I got my corporate finance side to actually do the documentation and M&A work with the circulars and SC and Brusa consultation. But if you speak to Astramina, Astramina is independent. Astramina is a boutique advisory firm licensed by, of course, the Securities Commission to undertake corporate finance advisory. To that extent, we have one key things that the bank doesn't have, which is independent. When you come and talk to me, you speak to the owners directly. All right, you speak to the owners, which is myself, and based on my experience, I give you my views about what you can do with your company. And because I'm independent, I don't have the legacy of I want to work with this bank, I want to work with that bank. I don't have that. I'm actually quite a blank sheet of paper. When the deal is happening and it is actually doable and workable, we'll think about which bank that we can work with. You know, bank is always a secondary sort of a component. In fact, I always go by the basis that the existing banker of the promoters. If, say, for instance, the owners already have a good banking relationship with XYZ Bank or an ABC Bank, you know, so I would say maybe we will start with these two banks because these are the ones that are familiar with your business, you know. So these are, I think, one of the very important criteria which none of the investment bank can have because they have a bank behind them. Whereas Astramina doesn't have a bank behind them. We have easily 10 banks behind us because I can work with any single banks that is in the market, correct? And I can group them together. You see, I have the ability to match and mix with them. You see, if you can only do 200 million, I'll do another one with you, another 150 million. So I already do 350 million deals. But you need me to be around to basically project manage and coordinate this deal to make it work. On your own, you may not be able to get it done. But through us, you can get it done. All right. That's, of course, one of the most important things I think I can survive for the last many, many years in the market. Of course, the other things I think are very critical to owners are confidentiality of information. You see, you speak to me, your information stop in my mouth and in my brain. You know, it doesn't go and discuss too much internally with the different banking division, even though they are what I call confidentiality sort of agreement that is being signed. But human being is just human being. You know, when you actually know something, sometimes you just chit chat, and then when you chit chat, the news will spread. Yeah, this is something it would never happen in Astramina because when owner talk to me, the secret stay with me. it doesn't need to actually spread. Yeah, it doesn't need to actually spread. And I look at it, firms, boutique firms like Astramina, it is a general practitioner. You know, you go and see doctor, you want to get a good GP. We are a general practitioner. We are a GP. We are not specialized. So when I diagnose you and discuss with you what sort of problems that you have, I give you some ideas how to come up and solve your problem. Yeah. From there, then we go and look for a specialist. I say, this one, I think we need a debt specialist. So we look for a debt company or a product specialist company to help us to basically structure something in a more deemed debt manners. But I'm a GP, so I know all the issues within the case itself. So just like when you admitted to hospital, you know, you got a surgeon, but the surgeon, you always go to the GP or the person or what we call the physician. The physician is the one that is supposed to diagnose you and make sure that you are safe and well before you send you to the operation room. So in the overall scheme of things, boutique advisory firms is a physician, it is a GP, and I think there is always room for us to survive in this competitive market. We are not a threat to the investment bank. We are not. Neither we are a threat to the bankers or the brokers. In fact, we complement them well. You see, we do a lot of things that they do, trust me. A lot of things that we spend time talking to owner, understanding their fear, understanding their problem, help them to solve their problem is something investment banking cannot do. First of all, they don't have the time. They have to handle easily 100 accounts or 200 accounts. Even any coverage will have to do that. But for me, I probably handle less than 10 or 5 accounts. I don't need to do that many, So I think that's why I think there's always a survival platform for boutique advisory firms, and I've never been fearful at all. And I will feel
Yep.
that it is a good compliment for us to work with them. We do all the work and organize things, and then eventually work with them, and then they also got the glory, and we all happy together.
Yep,
So that's
yep.
how it works. Yeah.
It makes a lot of sense.
I like that. I like the physician
GP.
approach because most of the physicians complain. You go to see the surgeon, he wants to cut you. You go and see the politician, he wants to put a drug into you. So I like the physician model about it. But let's get on to the corporate finance. And we're not medical show here, but
Yeah.
What an analogy to that, okay, Ravi and I. What an analogy. We are actually a GP, really.
Yeah.
I think myself an expert in equity placement.
So
maybe
go on, Roshan.
Go ahead. Ravi. I was thinking,
on this. Go on, Roshan.
Yeah, I mean, in terms of getting back into this whole privatization and I think you mentioned before M&A plays a big vital role many times, especially in Malaysia, in terms of driving privatization decisions and stuff. Talk us through that, through that whole scenario and what's happening in Malaysia primarily, or Southeast Asia.
I think privatization and M&A is something that is the bread and butters of investment bank, and also of course boutique advisory firms. I like to do M&A. I mean, because it is a lot of satisfaction, and is also a key component to this sort of privatization and M&A is actually valuation. You actually have to have a very good grasp of valuation. Without having a good grasp of valuation and what is valuation, you can't do M&A deal, and neither can you do privatization. You need to be able to form views clearly and be able to have the articulation skill to actually convince this side and convince the other side which side is supposed to be privatized and which side is supposed to be the mergers and buy over the other side. And that is all boiled down to personal and interaction skill, and also, of course, valuation. You need to be able to convince the sell side and the buy side. Why should the sell side sell and why should the buy side buy? And the value is the same. What is the motivating factor for one side to sell and for the other side to buy? And the value is the same. The value is the same because you can't be telling different values to different parties. So that's the tricks of it. And if you look at in terms of privatization today, I think Malaysia for the last 3 years, we probably see average around 10 to 15 privatization exercise go through every year, which some of them successful, some of them not successful. The general methods that we have are generally like maybe MGO or VGO exercise, selective capital repayment exercise, or a scheme of arrangement. You go through a scheme of arrangement to actually allow yourself to be privatized. And the other one is what we call asset liability route. You sell every asset and liability and try to privatize it in that sense. So there's not much secret is around there, and it's all boiled down to valuation, and it's all boiled down to how you convince each other and how to actually close the deal. How to actually close the deal.
Fantastic. Why don't you just share with us on a case study? Oh, I got a bit of an echo here. But why don't you share with us something that you've actually done, and that probably gives a lot more context to the story.
Okay, I think within Astramina, myself, I think within the history of Astramina for the last 13 years, I don't have done a privatization per se, but I think in my previous sort of employment, I've done one I think is a good example in terms of value creation. I think the example I want to cite is MMC privatized Malakoff. That happened, I think, in the probably 2005, 2006. That's where I think MMC launched a privatization of Malakoff through an asset and liability buyout. Why MMC at that point in time wanted to privatize Malakoff? Malakoff is actually one of the IPP company, key IPP company in Malaysia. Of course, they see value in terms of privatizing Malakoff, and then group them under MMC first, and then eventually with the plans, maybe a couple of years later, to release Malakoff, where the ongoing sort of IPP plans have been completed. So that exercise went through in this manner. So we privatize it through a leverage buyout, and we work basically with Goldman Sachs and CIMB to privatize the entity through an asset and liability route, and then eventually we got through and then privatize basically Malakoff. And in fact, arising from this privatization method of M&A through asset and liability route, at that point in time, the threshold for voting was still 51%. Yeah, because it was actually it's what we call ordinary resolution, because it's just an asset and liability acquisition. And we successfully got through. All right. With that, then what happened was the SC realized that this is too low a threshold to actually let people sell their asset in this manner. So eventually, SC actually formulate rules or guidelines to actually mention that any asset and liability privatization route also require a threshold of 75% present and voting in the meeting itself. So that itself is one of basically the evolution of corporate finance, where we start on with something innovation and try to get through a low threshold for privatization, which we successful. Subsequently, authority feel that that's not a good protection, so they have actually increased the threshold accordingly. So a couple of years later, you noted that Malakoff actually gone for relisting. Malakoff gone for relisting and then list themselves, and then eventually at that point in time, they already completed Tanjung Bin, which is one of the IPP plans already. That's where they gone for relisting, and that was successfully done. Yeah, and recently, I think for the last couple of months, you noted that MMC actually privatizing themselves. Because the MMC are announcing a selective capital repayment exercise to privatize themselves. I'm not involved in that exercise, but reading from the scheme of things, I certainly feel that the owners of MMC maybe feel that, MMC as a conglomerate is severely underpriced by the market. So good time to privatize. Good time to privatize and own everything yourself, through a selective capital repayment. What is a selective capital repayment? Selective capital repayment means that we only pay off the rest of the MI. The owner doesn't get paid. So this is one of the ways to actually save money in terms of the total fundraising that is required to privatize MMC. Yeah. So you only need to raise the funding required to basically pay off the minority shareholders itself. So in this case, all the minority shareholders that doesn't owned by basically Tan Sri Said Mokhtar's group of companies under MMC group itself. Yeah. Once this privatized, I honestly believe that the next plan that will happen is the listing of the Tanjung Pelepas port that is within the portfolio of MMC, which I think investors in today's market give a lot of weightage to operating company. They like to invest directly to operating company, hence there is a need basically to list the entity itself. So my guess is that, my guess, I can only say my guess, and the way I read how the corporate maneuvers will go is that eventually that should be the one that will eventually go for listing, and then basically raise the required money to actually pay off the funding that are used to basically privatize or selective capital repay the minority shareholders of MMC. Yeah. So I think MMC is a good example because it's gone through a lot of corporate maneuvers, and these are all M&A, and these are also involving privatization. Within the example of MMC, there are two privatization already. One is Malakoff, the other one is MMC themselves. Yeah.
Now, Muh Rong, if I were to ask you, you talked about valuations and you talked about the market. Of course, the original valuations is one of the benchmarks is the market cap of the original companies, right? But and then you've got your intrinsic value that you probably worked out and say, okay, this is what we could go in the market. But of course, there's risk and there's timing and so on. what would be, I mean, this is like we said, it's always a practical questions that we talk about in the market. But would you say, is there any kind of benchmark where you say, if someone came to you and said, well, we could make a 30% uplift, is that around a threshold you look at? Because you've got to look at 2 to 3 years, a lot of risk down there to make it happen. And you've got all the regulatory approvals, funding, etc. What kind of numbers are we talking, or returns or upsides you're looking before you even consider an exercise like this? I'm sure you don't do it for 5%, I'm pretty sure, right?
You are talking about a premium for privatization, is it?
Yeah, eventually when you exit on your other side of it, yeah. I'm sure if I came and said 200%, you'd probably say yes. And 5%, you'd probably say it's not worth your effort. Do you have a sense where the number feels like?
Okay. But I think for me, if you want to do any privatization, I'm just talking as a general rule of thumb. When I want to do any exercise in terms of privatization, I will first assess 2 things. First is, what is the market price of the stocks?
Correct.
That's the first criteria. What is the market price of the stocks? Second, of course, is what is the intrinsic value of the stock's value itself? You see, owners and myself, if I engage in the exercise, will have to form a view, what is the inherent value of the stocks in terms of the actual business valuation itself. It may take 5 years or 7 years or even 10 years to materialize that investment value or intrinsic value, I call it. It is something that is there, but it's just that the market doesn't recognize that. Maybe because market are worried about the risk factor, worried about this cannot be implemented, worried about it is a concession, worried about many, many factors, all right? Worried about the fact that it is very illiquid, there's no spread at all in the market, So you take into consideration of some of these factors, and then you ask yourself, what should be the fair value to actually pay people, to actually delist the counter, and then you have a decent return from the stock price that you buy today in the current market, and then decently rewarded you to basically privatize the company. So the normal rule of thumb based on market pricing should be around 20 to 30%. Yeah, very unusual that you want to pay anything higher than that. The reason being is that the market should be one of the platform to ascertain what are the buy and sell value on the stock exchange itself. That is a good thermometer. I call it a thermometer. A thermometer is something that will not lie. You put yourself into the tank, they will give you a temperature, whether you fever or no fever. So it is very clear that an exchange, a platform like a stock exchange, it is a thermometer of a pricing measurement. Yeah. So whoever actually eventually come and claim, you have to pay much, much more because of X, Y, Z. I think also must take a sit back and say that whoever come up with the money to privatize you, why would the guy do that at 100%? Then there will no more upside. Why should he do that? So as a shareholders, you need to opine carefully. Of course, you know that the intrinsic value is much, much higher, and the stock price is X only. So you make a decision whether you want to buy or take the offer or not take the offer. That's why you see a lot of the opinion that opine by the general market in totality, and especially independent advisors for MGO cases or for selective capital repayment cases or any of the privatization cases, you will note that most of them is opine in this manner. It is not fair, but it's reasonable. Not fair means that it's not opine or align with the intrinsic value of the company. But yet, taking into consideration the market environment, taking into consideration the illiquidity of the market, taking into consideration the stock price on its own, yes, you can consider, and it is reasonable for you to accept the offer with the premium of say 20 to 30%. It's up to you. You don't want, it's okay. You start with the stock price of back to say $2, rather than it can go up to $3. That itself, I can refer to the case of Cycle and Carriage. Cycle and Carriage did 2 rounds of privatization, but both also not successful. All right, both also not successful. But you can see when the stock price is not successful that time, the stock price back to square one. The stock price back to square one. So you must understand the stock price is a good thermometer and it's a good way of measuring the market views on the success or not successful an exercise. So if any minority shareholders feel that this is not a good price, then they must also have the guts to take the consequences that the stock price will come back down to before privatization price. I think that's market. That's market. Yeah, that's market.
Yeah, makes a lot of sense. We just want to say hi to a couple of folks that have joined in. We've got Jazbear, who's joined in. We've got Ida, who joins in every week, I think, on a Friday from Negeri Sembilan, and Sashi also saying hi to everyone. Just a quick call out. I mean, if you have any questions for Mandro or for Ravi, this is a good time for you to just shoot those questions in the chat, and we'll be happy to address as many of it. We're gonna, just before Ravi jumps in and continues this exciting dialogue with Wong Muh Rong, we're gonna just take a short little break. We'll be right back here right after this very, very quick short break. So, all right, see you guys in 30 seconds.
Woi, bro.
Apa dia?
Aku message kau 50 kali, tak balas.
Alah bro, aku tak ada time lah bro message. Aku sekarang tengah Necole bro. Necole lah, itu dia in sekarang. Tengah trending tengah kacau.
Kau cakap apa? Apa tu?
Necole. Kau tak tahu Necole? Google kau tahu? Necole kau tak tahu? Tak, Necole app untuk belajar bro. Semua tengah belajar guna Necole sekarang.
Ilmu
semua tengah guna Necole.
Share sikit lah.
Boleh bro, kau tengok macam ni bro.
Okay.
Kalau kau lembab, kau kena Necole bro.
Memang aku lembab sikit sebenarnya.
Bro, kalau kau nak laju, kau nak top, kau nak jadi CEO, kau kena guna Necole. Kau tahu kan pergi mana? Digital.dynamic.org. 200 je bro tahun.
Aku buat tu aku tak lembab dah.
Tak tahu bro, capacity kau macam mana. Tapi aku rasa Necole ni boleh tolong kau lah bro. Confirm.
Okay. Berapa?
RM200 je bro tahun.
Boleh lah duit raya pakai
selamba bro. Ni kau tengok ni bro. Cahaya bro, kau tengok ni. Ini daripada Howard bro. Power bro. Woi,
memang cantik.
Apa ni? Jangan ambil aku nya.
Okay.
Aduh.
Sorry. Aku teruja sangat lah.
Ni tak apa kita tunggu sini.
Welcome back to Rethinking Balance Sheets. We are here with Ravi and I from Stage 3 Capital and Wong Muh Rong, who has joined us. Thanks so much for this exciting dialogue. We've got different folks that have been joining in. If you have any questions at all regarding privatization, shoot them in the question section below. One of the things I'm curious about, because a lot of people say this is a great time for privatization. Now's a great time for M&A. Now's a great time. This current crisis, things will be undervalued. There's a lot of different sort of questions permeating in regards to privatization, especially in this current economic crisis, right? And I think you have a slightly different view of that. What is your take on that, Muh Rong?
Yeah, Roshan, that's a very perfectly good questions. I like to put analogies in this manner. I certainly like to have what we call beacons bags, because it costs a lot and it's also very beautiful. But in current market situation, I think even though you love to have a beacon bags, but it's too difficult to actually buy them. I use that as a starting preamble of this situation, is that currently in the market, if you look at it, every stocks are in the lowest level that you can possibly have. Every single owner, of course, in their mind, think about, I want to privatize the company because it is so cheap. I've never seen my share price drop below in this level for the last 30 years. I think it's a super good time to do that. But why is it so difficult to actually do privatization as well as this sort of privatization exercise in today's current market? You hardly see any announcement, even though there are some, but you should be seeing multiple of 10 times, rather than periodic or sporadic of cases. One of the key fundamental reason which I personally experience is that the funding requirements of privatization in today's market are already very, very different compared to 10 years ago. 10 years years ago, any investment bank happy to back a privatization exercise and say, I'm happy to be taken out in the next 24 months through another exercise, which is either through a refinancing or I do a IPO, I do a secondary sales on its own. I'm happy to do that. I actually have the appetite. I can do a leveraged buyout, happy to take you out. That was 10 years ago. But I think in between, there are some crises happen, Lehman Brothers crisis, some financial crisis, sort of crisis here and there, yeah? That resulting, there is a lot of rethinking in the balance sheet as well as the way banks want to do leverage buyout and want to do financing for M&A activities. In today's market, no bank is happy to go and fund a privatization exercise if they don't have a clear take-up source. When I say clear takeout source, means that, you actually have the money to pay me back, all right? And if you say, I want to go listing in 2 years down the road, cannot. That one is not a good takeout source because there are a lot of market risks. If you say, I want to sell an asset 2 years down the road, no, sorry, this is not a good takeout source because that is come with uncertainty. But I feel I can find somebody, I'm happy to divest this out. Sorry, that is not good enough. So what it means is that in today's market, what you need to do, if you want to do a privatization deal, please come up with cash. You must have your own cash to do the deal. Because if not, no bank will happy to fund you. If not, you must at least do 50%. Anything less than 50%, no bank is going to be side by side with you and say, oh, come, let's take the market risk and we do a privatization exercise because the stock price is very, very low. So that's what has changed in the thought process of banking. And that is also probably one of the good things that banks are still very strong today. They are not taking excessive risks. They are actually very prudent. I think I will use the word overly prudent to a certain extent and not prepared to take market risk anymore. Not prepared to take market risk anymore. And one of the reasons I feel why they are thinking like that is also because they are all convergent into one wholesale banking already. They are inverting and combining the investment banking as part of the overall banking environment. They call it wholesale banking. So wholesale banking means that every single component go to the same credit risk. It doesn't change the credit profile anymore. Everybody sit in the same place to evaluate the case, and nobody wants to be a bit more aggressive anymore. Yeah, and that's the pro and con, if you ask me. But of course, the bank become very, very strong because they are very careful, with the risk credit govern everything. But that also means that M&A activity is getting harder and harder to undertake in Malaysia. There is a need to strike a balance. Of course, as I said, you need to have a balanced development in the capital market itself. Cannot be overly prudent. Doesn't leave rooms for this sort of activities going on. So I think that's my thoughts at this moment. Yeah. So very unfortunate, we cannot own the big beacons.
Yeah. But I mean, it makes a lot of sense. I think because if not, you'll see an overflow of privatization happening. So it's that payback, right? The consistent payback that the banks can give.
Maybe that risk profile that you talked about, maybe not in the size that we are seeing, but the new platforms coming to raise money. There is a lot of liquidity out there, as you know that.
Yeah, they do.
The whole world has gone and pumped up, printed so much money over the last year, so that's why you got commodity, right? But I like to see the boys like P2P guys which were on the show. Here may be an opportunity. You can raise more money direct from public. Who knows? Yeah. Banks, once you got a credit policy, it's a credit policy. There's no budging from that credit policy. But what I really like what you said, Muh Rong, just to come back to what you said earlier about the intrinsic value and price discovery. Yes, stock market is the first level of price discovery. But yeah, and even if you want to go and do a privatization, like sometimes you look at the oil and gas sector, say, okay, I want to privatize my company, but if I have 50, 60 million bucks, do I privatize my small oil and gas company or go and buy Shell shares? Shell's trading at a deep discount, 6%, AAA, and going into, has so much risk diversification. So I suppose even even if you said you got money, right? Do you want to put all your eggs into that same basket of your own listed companies is going to be a challenge, right? But I think thanks, Muh Rong, for explaining. I think a lot of people are very confused when they see these independent reports saying, it's reasonable but not fair. But I would say or like you, I agree. Why would I pay full value of the intrinsic value and leave no upside going into a deal if I was going to privatize? Yeah. So I think there's a lot of unhappy people on these privatization deals, and they say, "Oh my goodness, we've been shortchanged." Probably the regulators also always concerned, listen to the public as well, and go along those lines. But at least that's good for. I mean, that's one great takeaway in the show is that understand. Why would anybody want to take all this risk, put their own money in there? Like you said, you might say, Malakoff, the plant would come more mature in 5 years. It will be producing, but God knows what's going to happen. There could be complete political risk in the country. 4 years later, there's a change in administration.
Precisely.
That concession agreement. Let's all have a discussion. Well, how were you awarded this concession agreement in the first place? Let's do an investigation in that. And the value will be tanking left, right, and center. So nothing is so simple. But sometimes retail investors think, oh, this is this is out. The big guy is out to screw the small man. Yeah. I mean, just adding to where you left it. Yeah.
Yeah, that's right. Yeah.
Anyway, Muh Rong, if you could just basically, you talked about funding, but just for the benefit of, like I said, this is a fairly technical show sometimes. And you talked about SCR, you talked about GEO, you talked about scheme of arrangements and scheme. How would you make a decision? What are these approaches, and how would you actually advise a client on which approach to take? And I suppose the tricky one is, how do you ever get to that wonderful threshold of getting the scheme through? I suppose that's the magic sauce that you bring to the deal, isn't it?
Not really, actually, Ravi. I think as to what method to use is very much depends on what the owners want. Can they live with it that if the companies cannot be delisted? I think the fundamental questions that we need to ask the owners, yes, I know you want to privatize the company, all right, but can you live with it in a situation where you come and live in a situation where you cannot delist yourself? You can increase your shareholding, but you cannot delist yourself. So if the owners say that, I'm okay, but what I'm looking for is to increase my shares because stock market very low now, is a perfect good opportunity for me to buy the shares. So I don't mind. Eventually, I cannot privatize the company. Although in my circular and in my VGO document or whatever document that I put, I said I want to delist the counter. But eventually, I don't get that. I'm also okay. You understand? I think that one, you have to listen to your own heart and see whether you think, you just want to increase from 40% to 60%, 70%, or you actually want to delist the whole thing to own 100% of it. That has a lot of bearings in terms of what method of privatization to use. All right. If your objective is actually just to basically wanted to increase your stake, all right, then I think I will certainly recommend you to consider what I call a VGO or a general offer. All right, because that itself leave you rooms for people not happy to sell, don't sell lah. People happy to sell to me. Yeah. But if your objective is that you must own the company 100%, then you live with only two options. One is a selective capital repayment. Second is what we call a scheme of arrangement. So these two items require a threshold of more than 75% present and voting. So in other words, that it will be majority, in fact, not more than, in fact, it's a special resolution already, where after the sort of what we call a court convened meeting, you actually get the court to order the transaction itself through a selective capital repayment or a scheme of arrangement. You get me? So for that sort of method, it's either you got everything or you got none. All right? You wouldn't have a situation where you increase your stake currently, say 40%, to halfway to 70% under a scheme of arrangement or a selective capital repayment. It's impossible. because the rule doesn't allow you to do that. So either you have it or you don't have it. That is the decision that the shareholders have to make for selective capital repayment and scheme arrangement. But for GO, because it's an individual, I send you a document for you to consider whether you want to sell or don't sell. If you don't want to sell, it's okay, you keep it. If you want to sell, you sell it to me, I will take it. And the chances is that I will increase my stake from current, say, 40% to say maybe 60% or 70%. You get me? So that is very much depending on what the promoter or the owners want. But in any event, whichever method that you adopt, you have to make sure that you are in 100% funding readiness. In other words, that you have to make sure that you are already in funding in place in a 100% manner in order for you to get ready this particular exercise. Of course, you can minus off your own stake. Yeah, you can minus off your own stake. I'm talking about the minority. Yeah. So that's how it works. Did I answer your question, Ravi? Yeah.
No,
Russia?
I think definitely, Muh Rong, that's helpful. But it's what I was trying to perhaps get is what are the tactics, especially when you have the yes no situation, all or nothing situations. And I'm sure when they've got the investment banks, they've got the funding in place. Now you got to make that 75%. I suppose one option is to continuously to offer more. It all comes down to negotiating tactics, I suppose, at this stage. Maybe not directly negotiating. How do you manage that communication to get over that line, especially where you need that 75% supermajority, and the major shareholder can't vote usually, right? So here it's an absolute challenge to get that 75%. How does one go about doing that?
I think it's important that, as I said, you have to form a valuation, what is intrinsic and what is actually fair and reasonable to privatize it. So you have to ask yourself whether a 30% premium to the current stock price, is it something that the investor are prepared to take? If this is something that they're prepared to take, it's no longer too much relevant what is intrinsic value anymore, because intrinsic value is intrinsic value. Until somebody is happy to pay you the intrinsic value has no value, because it is just a value. You must have a buyer and a seller to endorse a value. Yeah, you must have a buyer and seller to endorse a value. Just like a house. I want to sell my house. I want to sell at 5 million. But there are no buyer happy to buy at 5 million. And the buyer only happy to buy at 3 million. My house is only worth 3 million. Of course, my intrinsic value is 5 million. But sorry, you just don't have a buyer. So it's the same thing in stock market. So when you privatize stocks, it's the same. Your intrinsic value can be 5 million. But unfortunately, the buyer is only happy to pay 3. So you have to accept the fact that it's only 3, and then you have to ask yourself, am I happy with the 3, given the fact that I already got a premium of, say, 30%? But of course, some of the investors, if their costs are higher than the 3, and their cost is 4 ringgit, then it's too bad. You have to make a decision whether you want to cut loss or not. I mean, I think we can't guarantee everybody make money in the stock market, yeah. But if you already make a decision to buy at that point in time, of course, that was the views that you take that particular stock will at least higher than that price, yeah. But today, if the market has gone back down to rock bottom and you started revisiting that, then you have to ask yourself, am I happy to cut loss when the offer actually lies on my table? Yeah, I think it is a bit philosophical, sorry, gentlemen. But as I said, it is a philosophical exercise. Yeah, it is a philosophical exercise. And you have to ask honestly to your own heart. Yeah, nobody can guarantee stock market make money. Whoever knows that Server Dynamic, a darling in the stock market, can go to 30, 40 cents or 40 cents in today's market? Who believe that? But that's stock market, When people sell, when people lost confidence, that's where it will just go down and down and down and down. And when you want to recover back, it takes a lot of effort to build back trust, because people need to see things are actually back to order, assured things are in order before you actually jump into the pool game.
I think this has been one of the cases. I think some of the cases in Malaysia has been around that, where you have international investors buying at a very large price and then trying to do the privatization later. Can't be done because I bought it so much and I can't take a loss. I find that a bit of an odd argument, because in the end, that means you just want to wait until the price comes back, or you're trying to negotiate to get, the privatized party to pay you that premium, and that's not going to happen. So I see a lot of them they just get stuck, and I suppose nobody wants to pay more and more to win the battle, and then find yourself making loss. Somebody else's loss comes your loss after that.
Correct. Compared to a situation, especially if the market has no liquidity to absorb the price that you have. So it's naturally, you have to ask yourself whether are you prepared to cut loss. If you don't, then sorry, we get stuck again. So it is that's why I think M&A and privatization exercise are very difficult to do, and it's also very challenging. And it's I think changing facts all the time, and I think the temperature is also moving all the time. So you will never know until you actually go for the actual physical voting on the exercise itself.
And we it's been an exciting discussion. I realized 45 minutes have gone by, having this dialogue. But I know it seems to be a really tough one to do in this environment. But in your view, is there sectors or industries or organizations that could be potentially ripe to be considered for privatization at this point in time? I mean, should there be some of us looking at it as an option?
If you ask me, I think market is full of liquidity. I think if you ask the bank, if you ask the market, anybody got cash or not? God, we have cash, we don't know where to put. Happy to all start in FD and with a return of probably less than 2%. I mean, there are a lot of people got money actually, but they're all very scared where to put the money. So I think some of them. No. I think one of them has actually started doing very, very well in terms of fundraising is actually private equity firms. I think if you look at Credo has recently just completed their number 5 funds. And that was the largest fund that they ever raised. And don't even talk to investor. Just go by Zoom call and on live virtual, they already raised the money. What does it mean? It means that a lot of people got money, don't know where to park the money. So happy to partner with Credo, because Credo has a good track record in terms of value creation. All right. So I use Credo as an example because Credo is one of the very renowned brand in Malaysia and also international. And they have successfully done very successful cases like My DIY and CTOS. So one of the possibility I think that actually can create a lot of opportunity for people like Credo and private equity firms. They raise money, and their eyes and their antenna should be on the lookout. Try to partners, basically promoters that actually can deliver them intrinsic value over the next 5 years or 3 years time. One of the cases I thought it was good for citing as an example is Nirvana. Ravi mentioned Nirvana today. Nirvana privatized Nirvana. Tan Sri, I think I think one of the Tan Sri, the Nirvana owners, privatized Nirvana with Nevis. They did a deal to privatize with Nevis, and then they list that in Hong Kong, and after a couple of years, they privatized themselves as well, I think throughout this exercise, Tan Sri makes some money, of course, and similarly for Nevis, So I do see, even though banks are not happy to fund because of the risk credit environments, but I think private equity firms has some opportunities here, but of course, private equity firms has to form the views which sectors that they would like to which sector they would like to actually participate in this market field itself. So then they can do that and see whether it works. I think private equity firms will have a lot of opportunities. In fact, CVC privatized together with multipurpose on magnums. So they do have these sort of opportunities happen, which I was having the privilege to work with them. So easily these are deals that may happen in the market.
So I think as we wrap up, maybe Ravi, you want to just have your final thoughts, and then we'll get back on the final thoughts from Muh Rong in a second.
I think Muh Rong hit it on the nail. At the end of the day, all these deals, I mean, all the intrinsic value calculations, all that, the technical part of the corporate finance is always interesting, but eventually it's an emotional decision for a lot of people to sell their stock when they face the document in front of them, especially if you're holding a large stake, like I said, those which came into like one of the banks.
Especially when you lose money.
Yep.
Especially when you lose
You
money,
lose
right?
money.
Especially when you lose money compared to your costs, you'll be very, very emotional, and you just feel you're unfairly treated. But your investment is 10 years ago. Today's market are very different, so you have to make that call. If you're not happy, stuck with it, So because it's a job.
A mutual friend of ours is a senior banker which does a lot of distress restructuring. When we go in and say the banks are very emotional to take a haircut, he said the time to be emotional was when you were lending the money. I say the time to be emotional and be careful was when you were investing the money, not when it comes to selling. You made your money the day you invested. Actually, that's what they tell about property. I would say that about stocks, everything. The way you made your money was when the day you invested carefully. So people, when you see, I'm sure this, whilst you say this is a fairly technical show, people do own short stocks. When you see the offer in front of you, try not to be too emotional. Look at it clinically. Remember, the time you made or lost the money was when you invested, not when you came to sell.
Yeah, true. Yeah. So I think I have nothing much to add, actually, honestly, because I think it's all boiled down to be honest and be having integrity on whatever exercises that you do, and most importantly, you have to see the facts and assess the facts carefully, and not be too emotional, and look at the facts and see you want to up, you want to in, you want to take or you don't want to take, and everything is actually measurable. Everything is measurable at a certain point in time, whether it's today or 10 years ago or 10 years later. 10 years later, we wouldn't know what it will be, because it's only time we'll know later. But what you have on the table is what you have to decide. So that's why I think corporate finance is a very interesting
it is,
industry. It is a very interesting industry that I think is full of evolution and also full of uncertainty.
And it's continuing to evolve.
I would never form a view and say I close a deal until it's physically closed. You can be on the jobs, but it is just on the job, and it's not closing a deal. Closing a deal comes with a lot of efforts, and it's very difficult, and it's very, very difficult.
Well, thanks so much, Wong Muh Rong, for joining us today, and Ravi Navaratnam from Sage Capital. Has been amazing. I mean, privatization, who would have thought we would go in almost an hour having a deep dialogue on privatization. But as always, with every of it, there's so much to learn and there's so much to explore. And I think a big key takeaway is about the assumption that we assume that because assets are cheap, today is a great time to do privatization. But at the flip side, there's the funding side, right? How are we going to fund that whole thing? And with all the funding structures changing and banking policies being what it is today, it's going to be a bit of a challenge. But yet there is some opportunities because liquidity is available in the market today. So lots of things, lots of insights. Thanks everyone for being there. Ravi, your final quick take, 10 seconds, 15 seconds piece of advice as we wrap this up.
Like I said, I think this one is as usual. I think we just go back to a little bit of the doctor talk today. Stay safe, get your vaccination. I'm glad I got my second one. That's primary. If you don't have your health, nothing else matters.
And it continues to be a challenging situation politically and economically and also I guess physically, with all the health concerns around us. So stay safe, everyone. Have a great weekend. We're gonna end with a short, quick video on Happily, and we wish you a fantastic weekend ahead, everybody. Stay well, stay safe, stay blessed. Bye bye from Rethinking Balance Sheets.
Thank you.
Bye, everyone.